Welcome to Build a Lender podcast, devoted to educating you on a variety of financial subjects with an emphasis on real estate and real estate finance. Please click the button to subscribe to my channel so you don't miss an episode. Then like and share your favorite episodes. Hi, this is Bill Rodriguez, and welcome to this week's episode of Build a Lender. I'm your host, Bill the Lender, Bill Rodriguez, Cornerstone Home Lending. Wanted to welcome my audience and talk to you guys a little bit about things that are coming up in the media. If you are thinking about buying a home or you're thinking about investing in real estate, making a move, whether you're moving up, moving down, moving sideways, whatever that looks like, there are a lot of market influencers that may be shaping your decisions. And one of the things that keeps coming up is the housing bubble, the possibility of a housing bubble, and what that may look like and how it may impact you as a consumer. Obviously, if you're thinking about making a move in real estate and you don't know a lot about the housing market and you're concerned about a housing bubble, that may have you pump the brakes a little bit and trying to decide if it makes sense for you to buy. Are you going to make a return on your investment? And so what we want to talk about is defining the housing bubble, what it is, how it could impact you, what it means, the basics of it, understanding it better. We're going to talk about 3 myths that we're going to dispel and talk about how they have looked in the past compared to how they look today and make those direct comparisons. And then we're going to talk about other market influencers that are going to continue to support a strong housing market for the foreseeable future. Now, let's first talk about housing bubble. A housing bubble is a period of time where interest in the market spikes and there's huge demand, and that creates a shortage in supply. It may create a frenzy, some speculation that drives housing prices to spike for this period of time. And then there's this change in market dynamics, which creates demand to drop off and creates excess supply. And then we see the bubble burst, is what you're normally used to hearing. And suddenly housing prices fall. So that could be scary if you're a consumer considering buying a home, wondering if I buy now, is this the height of the market? If I buy and I pay over asking, am I going to lose money? And my short answer to you is no. But we're going to talk about the first myth and some of these market dynamics that are out there. The first myth is that this is a similar situation to what we saw in 2008 and 2009. Now, housing goes in cycles. Before our most recent financial crisis back in 2008, the housing meltdown, we've had a lot of these different types of cycles, bubbles, if you will, and they've come and gone. They are in recorded history. They are anomalous, but when you're going through them, they do have significant impact to you. And that had a lot of impact to consumers in 2008 and 2009. But the thing that was different was the build up to that. Now, a normal market really is looking at 6 to 9 months inventory. Okay. That is, 4 to 6% appreciation. It's considered a healthy market. And that's the market that we saw leading up into 2008, 2009. And because of the health of the market that had continued for so long, underwriting standards, lending standard had loosened their guidelines to allow more people to afford home ownership, perhaps, arguably. Maybe some folks we banked on back then we shouldn't have. So as a consumer, if you were buying a home back then, it was much easier for you to get approved for financing. And like we said, there is your standard A paper, we call it, our bread and butter, our conventional inside of the box, if you will, very conventional financing. And then you have the subprime market, which is what we called it back then. Now it's called non-qualified mortgages or non-QM. And those subprime loans were more of the exotic loans. They're adjustable rate mortgages. They were interest only. They were all of these other types of mortgages that maybe had higher default rates, maybe had riskier credit standards. And those were packaged with the good loans. So when those folks couldn't continue to make their payments, there was a cascading effect that affected all financial markets and created a foreclosure situation. Now, that foreclosure situation doubled the amount of inventory. And that was the catalyst where we saw housing prices fall. In addition to having a surplus at that time, those exotic mortgages, these underwriting guidelines suddenly restricted, and now less people could obtain financing. So it became incredibly difficult to get a loan. Banks stopped lending to builders. The housing market essentially shut down. So this created a big problem. We don't have that issue right now, not even close. In fact, the way that we bundle mortgages together is entirely different, and we've put in regulations and stopgaps to prevent that from ever happening again. So it's just not possible, okay? The second myth is that this foreclosure surplus is going to actually create more housing and solve this gap, this problem, this inventory problem. And from the credit underwriting guidelines, I sort of explain that, went a little deeper into that so that you could have some context for why that won't happen again. But from the forbearance piece of this, which is where we saw the potential for this to happen in recent times during the pandemic, forbearance meaning that if I'm a homeowner and I get affected because of the pandemic, because I'm either furloughed, the world shut down, I can't go to work, nobody's buying my products, things have essentially stopped, I can stop making my mortgage payments for a period of time. That started at 3 months, then went to 6 months. And that went all the way until we stopped the forbearance window in August of 2021. Now, at the height of that, there were up to 5 million homes across the nation, homeowners, households, that had gone into the forbearance process. And that was a huge concern for the market in general, because we thought that we may see default rates as high as 12 to 14% in all of the people that had decided to take Fannie and Freddie up on this process of delaying their payments. Now, what we saw, though, is because more Americans have seen appreciation. The average American has over 30% appreciation in their home. They have a ton of different ways to sort of work with the process, whether they get hired back to work, their circumstances change, things have returned back to normal. They're able to make those payments either in a lump sum or over time and eventually refinance themselves out of the forbearance, catch themselves up, modify the loan, tack it on to the end because they have so much equity. The circumstances of the market are that it's given people more flexibility. So we've seen forbearances continue to decline all the way through to 2022 to where it's really become a non-issue. The last stats that I saw were from CNBC, and it said we really only have, from that expected 12 to 14%, only 3% of American households in some portion of the foreclosure early stages process. Out of that 3%, that equates to a number of 264,000 households, which is a drop in the bucket. 38,000 of those households are actually in foreclosure. But when you look at the actual numbers of what it would take to move the needle, you actually understand that those 38,000 homes are going to be quickly absorbed with all of the demand. And why I say that is because the National Association of Realtors reported that for the first time, housing units in the United States dropped under 1 million. And for you to make a dent in the inventory problem, you would have to double that number. That'll give you 3 months of inventory. So you'd have to go from, let's say, 1 million to 2 million households. And what we're going to see is that the third myth, you cannot build yourself out of this crisis. Now, what we need in terms of units annualized to make a dent and just keep up with demand is 1.5 million. And that's just average demand. That's not even taking into account some of the other consumer demographics that are having a larger impact than we've seen or have actually been able to equate into these housing numbers until now. Because the millennial and Y generations are just jumping in and they're creating another $1.3 million or million unit need in the marketplace that we just simply can't keep up with. Now, from a builder standpoint, the cost of land is going up. We're not creating any more land. It's not getting any cheaper. The municipalities make it very difficult for you to not only acquire the land, but then parcel it out and prep it to build. And so there's that red tape that's slowing things down as well. On top of that, you've got supply chain issues. You've got labor shortages. And you need 1.5 million to keep up with regular demand. We're only building at this pace of about 1.2 million with the labor shortages and all of the other things that I've mentioned. So we already have a deficit there. Now we're going to add these new consumer demographics, the millennial and the Y generation, that are creating additional demand on the market that we simply cannot keep up with. We would need to be building at a pace of around 2.8 million units a year. And currently, because of supply chain and labor shortages, we're at 1.2. So there's a huge shortage. We're looking at, over the next 5 years, having about a 5 million unit shortage in the housing market. So what does that mean to you as a consumer? Well, first of all, the best news is all of that short supply and high demand means that it's going to continue to support price appreciation and pricing stability. So if you're an investor, or you're a first-time home buyer, or you're a move up or move down, and you're paying over asking, you are still going to make the rate of return that you're looking for this to be a good investment that you should consider looking at. Now, with rising interest rates, we're hoping that the market can slow down a little bit, so we're not bidding $50,000, $100,000 over asking. There's not 22 competing contracts for us to get our offer accepted, and that it does return to somewhat healthy market appreciation, which is between 4 and 6%. But what we're seeing is that the projection for this year in 2022 was 10% market appreciation. Metro in Colorado, which is where this podcast is based, we saw 9% appreciation in the first quarter alone, which is just staggering. And it seems unsustainable, which is why you're hearing about a housing bubble. But when you look at the stats and you're understanding this from an educated consumer mindset, they support strong housing appreciation going forward. Now, thanks for joining me today. I'm Bill Rodriguez, your host of Bill the Lender podcast. And if you're thinking about making a move, buying, selling, moving up, moving down, and you have some questions, you want to talk to somebody, I would love to answer your questions. You can reach out to me at billthelender.com, or you can call me or text at 303-877-6323. And until next time, we'll see you soon. Thanks for listening to Bill the Lender podcast. Please reach out to me with any questions at 303 877 6323.